Stocks are poised to end the week at or slightly below last Friday's close, even after two major IPOs and a 20% premium bid for Barnes & Noble today. The lackluster trading doesn't worry our next guest, though, who is among the most bullish strategists polled by us here at Bloomberg. Binky Chadha is the chief U.S. equity strategist at Deutsche Bank Securities. He expects the S&P 500 index will end the year near 1550 or 15% above its current level. Binky, welcome to the program. Thanks for joining us.
Pleasure,
I think
man.
it is the most bullish target I've heard, at least from a major bank here. Why, with all of the bad news on housing, all of the bad news out of Japan, the awful news out of Europe, would you be this bullish?
So in terms of the target, I mean, the first point I would make is this is not a new target. And the key issue really is, how are U.S. corporates doing? And here the news, I would say, is very, very good. If you look at Q1 earnings, the two key concerns that everybody has or had, I would say, number one is, margins have run up very high and everybody expected them to come down. Margins have not only held very well in there, they're back up in the first quarter. So U.S. corporates are absorbing the cost increases that we've seen in oil and commodities. And the second very important thing to note is top line growth for the S&P 500 is growing 8, 10, and 12% the last 3 quarters. So that's very, very good news. It's well above GDP growth rates. So earnings have been good, and the outlook looks good. We are trading at 13 times the next 12 months earnings.
Which is cheap, you think, right?
Which is very cheap.
13
yes.
times next year's earnings, I think almost 14 times trailing earnings. Do you expect, though, earnings growth to kind of taper off here? Because we have had some pretty strong growth, but we're coming from a relatively low position. So, can these companies continue generating these kind of growth numbers going through 2011?
So there's no doubt that earnings growth is decelerating, but we're talking about decelerating from 50 and 60% growth rates to 10 and 15% growth rates. So still very, very healthy growth. The way I would think about the S&P 500 and valuation is, if you annualize first quarter's earnings, you do a modest seasonal adjustment, earnings are already running up at basically $95 or a little bit over that. And so, last 12 months earnings or trailing earnings are just going to move up by $5 without any sequential growth. Those $5 at current multiples is 75 points on the S&P. We do expect earnings growth for the reasons that I mentioned, well-supported margins and robust top-line growth despite slow GDP growth. And that's going to give you another 75 points. And there should be some, multiple expansion of half a point or so.
What about, though, a shrinkage of almost 4% in the Japanese GDP? It looks like problems for not just Greece, but maybe Spain and Portugal as well. Sure. What drives this earnings growth going forward? Who's buying this stuff?
So number one, on Japan, clearly, the sequence of events is we go down as a result of the disaster that we've had. But second half growth should be much more positive. And that is one of the reasons for why we believe that the slowdown that we've seen in the U.S. data is essentially temporary, number one. Number two, the impact of oil prices. Oil prices have come off of where they were. And it's a question of absorbing those oil price increases. And so the corrections that we've seen in oil and commodities, are very, very positive, basically, for the economy.
Is that a good, people worry about the end of QE2, right? But a lot of people are saying the reason we saw this huge run up in commodity prices, including oil, is because of quantitative easing. When that's done, we've seen commodity prices obviously retreat already a lot. Is that kind of a sigh of relief for at least the consumer?
Yeah, our expectation was that basically QE2 was a key reason for why the dollar went down, oil and commodities went up, and you can see that in the flows and the positioning data. And our expectation was that the end of QE2, or really what's more important for the market is the pricing in of the end of QE2, made them very, very vulnerable, oil and commodities to the downside and the dollar to the upside. And I would say the good news is it looks like, much of those corrections has already basically taken place. I think oil and commodities still look a bit expensive, and so we're going to continue to see some volatility here.
And Binky, guys have been coming on this show since the end of 2010, saying you want to rotate into the high-quality, big names. It doesn't seem like we've seen that much of a run-up in those names. Where do you think people should be investing?
So, I would basically answer that question at two levels. Number one is at the sector level, we think that right here, the cyclicals, the domestic cyclicals, which would be the financials, the industrials, consumer discretionary, and particularly tech, look extremely cheap relative to the defensives, which would be healthcare staples.
Well, even though Larry Summers came out and
utilities.
said maybe there's a tech bubble right now. Do you see that?
Yeah, I would still say the domestic cyclicals look very, very cheap. They've underperformed massively since the March 15th bottom in equities and the subsequent move higher in equities. And that's really out of character. It's out of nature. So I don't think it's anything to do with the late cycle. I think it's much more to do with the macro data slowdown that we've seen. And we think, like I said earlier, that is temporary, and so this will turn, so we would be long the cyclicals. We fully share the view about higher quality. We have actually a thematic baskets, but it's not just a question about buying quality. What we do is we overlay higher quality with a measure of value, which is cheap basically on normalized or cyclically adjusted earnings if you want. And that basket actually has done extremely well since we put it on about a year ago. It's outperformed the S&P by a good 12 percentage points. It's outperformed the S&P again significantly this year.
You're not going to give me any specific names, though? I mean, high quality, big stocks,
These are quant baskets with 50 names, so if you've got the time, I can run you through 50 names. But that would take a little while.
Anyone at home, email me at mtmiller@bloomberg.net, and I'll shoot you Binky's basket list. What about...
Actually, they're available on Bloomberg. You can look up, there's a ticker, and you can see the composition of the basket. So
we hope all viewers access their terminals, but I'm not sure that everyone has one.
DBUS quality is what it's called.
Let's talk about... what about the IPOs that happened this week? It was pretty insane. The story on LinkedIn, right? I mean, jumping up to 120 from 45. Meanwhile, Glencore stayed the same, but of course they were going for a lot more money there.
Yeah, I think that we are still in the very early stages, basically, of the IPO cycle. But as long as this business cycle continues, we are very, very early stages in a lot of the capital markets activity. It's not just IPOs; it's also M&A, and I would argue, and LBOs really still have basically to get going. And what I see that as is really a reflection of corporate confidence, basically, in the future. And here I would point really to the M&A deals, where corporates are paying a pretty significant premium, and that means that they have not only the cash, but they also have much greater confidence, basically, in the future.
Doesn't feel frothy to you? I mean, $8.5 billion for Skype.
There are going to be deals here and there that may or may not get frothy, but the market as a whole is trading at 13 times next year's earnings. To keep it in perspective, at the lows last summer when things felt pretty bad, we were trading at 13.5 times trailing earnings. So it's important to keep in mind, and this is what I said at the very beginning, earnings have grown, and they've grown pretty significantly. So it's a question of a belief in the sustainability of those earnings.
All right, hey, Binky, thanks so much for joining us. Really appreciate it. Binky Chadha there from Deutsche Bank.